Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Well, one thing that I can say without fear of contradiction is that the election of Donald Trump to the U.S. presidency has certainly altered the outlook for the U.S. economy, and in all probability, the global economy as well. But the second thing that I have to add is, that is probably more germane to the immediate market outlook, is that after the last two presidential elections at least, the stock market has rallied nicely. And that is precisely what we are seeing now. As far as the FANGs go, I do not necessarily expect that the Trump presidency will actually affect any of the stocks directly as far as their growth outlook and fundamentals are concerned, save perhaps one, Tesla. But you would never know it from the reaction of the stock to the election results. Trump has indicated some hostility towards the electric vehicle market as part of his general distaste for the Green Revolution. And to that, I should add the potential for massive tariffs on imports from China. So why is Tesla going up like a rocket? My guess is that Musk is hoping that his $100 million investment in Trump will pay off one way or the other. He has certainly done his best to ingratiate himself with Trump. Mind you, reversing the trend to electric vehicles in the U.S. and the massive investment in the EV infrastructure will take years, and notably, much of that EV infrastructure is in the so-called red states. Last week, I reported on the quarterly results for 7 of the 8 FANGs, and this week we are at least seeing some positive price movement, albeit most are quite modest. I observe that most of the FANGs seem focused on putting on a brave face going forward in the expectation that the AI-generated improvements are in the wings. Beyond that, I don't see any changes in trends that were not already in force. Now, key stock markets are closing in on the levels when we should be very much increasingly wary and selective as to the stocks we are holding. And this applies most notably to the NASDAQ 100, as both times in recent years that the NASDAQ has reached its HB1 price, that's 9.5 times book value, it has suffered significant setbacks. And you remember a few short weeks ago, I showed you what those numbers were. Next week, I will be inviting you to a special free webinar on the outlook for gold and gold shares, with special reference to what I call black hole economics, the underlying mathematics themselves, which are central to the key drivers of all of our SVA charts. Anyway, without further ado, let's take a close look at what happened this week. As always, before I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, well, let's start off with Amazon, and Amazon just keeps trucking right along that bubble price. And as long as it does that, by the way, I don't think we can complain too much. By the way, way back in March of 2023, the market, the stock bottomed at its mid-super growth price. That's 5.5 times book, and that was a 24-year valuation low. And now, as long as it stays here, of course, what we've got here is a balance sheet that's growing very nicely. So just being there and not much movement away from the bubble price should be positive for your portfolio. Alphabet bottomed perfectly for a second time at its mid-super growth price. That's 5.5 times book value. Now, you'll notice, by the way, that it bottomed there perfectly in, early 2024, had a nice run to its bubble price, 7.4 times book, and set back again. Now, you'll see here that it doesn't look as if it quite got there. Well, actually, it did. But you can see by that little triangle that we had a new balance sheet, and what that balance sheet did is it pulled down the structural price underneath the stock. Its target remains its bubble price. So there is a good, solid buy that we just had recently. Should be paying off nicely for you. Apple, remember last week I was having a struggle trying to see what the heck was happening with Apple with the balance sheet, which was absolutely critical to understanding. And this week we've got the new balance sheet, and indeed those $32 billion of buybacks have done exactly what I expected, has pulled down all of those structural prices. So the best we can say is, okay, so now what? And of course, when we look at where the earnings and the fair market value are, they're a lot below the current price. However, let's take a look at it from a different point of view. Here's the longer term view of the stock, and I'm going to click on this little box in the bottom, the price to book. And now we get to take a look at the ROI for the, it's the ROE for the for Apple, and we see that the ROE has leveled out, as has the valuation, because that's what the valuation is now. The valuation is quite a bit higher than the ROE value, and given that the price is up here, the valuation is up here, there is certainly some downwards room for price revision. I would be quite cautious about Apple at the present time. Microsoft has nearly made it back down to its HB1 price, and that, of course, has been my target for quite a long while. So if it gets there, in between FANG Friday calls, I think I might consider doing some buying if I were you. Now, look at the growth of the fair market value down there. Hasn't moved a great deal, so I would have to add to my buy recommendation. But beware, the HB1 price, 9.5 times book, must hold. Meta remains caught between its bubble price, 7.4 times book, and its HB1 price, 9.5 times book. And you kind of wonder, why doesn't the stock sort of get on its way and finish the job? Well, more recently, I have showed you one reason why, and that is to say that the stock, ever since, the last 6 years, since 2018, has tended to peak at its bubble price, and therefore breaking out there takes it into new high territory. Or does it? Well, now let's go back to the time when Meta actually went public. And here we see that first powerful rise in the valuation of the company, and it actually got up to, it broke over its bubble price and actually got up to its HB1. Well, go forward now to 2024, some 10 years, and we're back at that old high. It is small wonder that this stock is struggling here. I still hope that it can get to its HB1, however. Nvidia just continues to ride along its HB7 price. Now, there's been quite an acceleration, of course, in the structural prices themselves, but I do have to warn you about something that showed up in Fred Hickey's really wonderful monthly publication about high technology stocks. And that is to say that beware that Nvidia, when it does set back, can set back quite substantially. And there had been two, since 2018, there's been two huge setbacks, and they have averaged about 70%. Well, where did the setbacks bottom, by the way? Look at, they bottomed at their fair market value. Okay. Now, then the fair market fell away, but it bottomed at its fair market value, and it tried to do that again here. And I think that had we been able to project that number there, because you see that has fallen away too, that it in point of fact fell just about perfectly at its own fair market value. Well, its own fair market value today is some 66% below the current price. So if there is a setback in Nvidia, be careful. History tells you that the setback can be very substantial. Tesla, well, Tesla has surprisingly to me broken out over its HB2 price, and it's having another nice day today, eh? So maybe we're heading back up to its HB3. Well, it's been there before. Still when I look at the earnings and I look at the growth of the company, I've got to say, what's it doing up there? But as I said in my introduction, maybe that $100 million investment in Donald Trump is paying off for Elon Musk. Small potatoes for a man worth billions. Finally, Netflix has broken out nicely over its HB2 price. Forward growth expectations, by consensus numbers, are 26% a year for the next 5 years. So it probably belongs up here. Anyway, that breakout is quite promising. So to briefly recap, Amazon had excellent numbers, but so far they're only enough to keep the stock at slightly above its bubble price. Still, nice balance sheet growth suggests that this may be all that you need, okay, to hold the valuation up. Alphabet's buy signal at its MSG price, 5.5 times book, still looks good to me. And now, I think, as I plainly showed you, you can see that a probable top may be coming into view. The next critical balance sheet update was Apple, and this week we saw what the $32 billion share buyback entailed. Still, very little growth in evidence. I remain concerned here. Microsoft keeps slipping slowly towards my long-awaited HB1 price target, but with consensus growth expectations for the year at only 11%, I shall be watching with interest to see whether that valuation level can hold. Meta had nice revenue numbers and scintillating net income results. History seems to be weighing heavily on the stock's valuation, however, as I showed you. And the HB1, that's 9.5 times book, is still all that I personally would expect for now. Nvidia has not reported yet. I have no update. Like those Kleenex table napkins that are in that commercial, the share valuation clings like cloth to the HB7. But history does warn us that when the stock set back, it can be fierce. Tesla is the star of the show, with the shares breaking out over the HB2 price, 12 times book, despite indifferent numbers and a questionable outlook. Clearly, however, Musk's $100 million investment in Trump looks to be paying off in the short term. And even if revenue and earnings increase by the expected 16.3% for revenue and 35% for the earnings, respectively, the shares are still massively overvalued. Finally, Netflix is holding just above its HB2, 12 times book, on nice revenue growth and strong earnings growth. Consensus expectations for the next 5 years, 26%. Looks like a good hold to me. Anyway, that's all for this week. And for now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you next week.